Well, good evening, everyone. I'd like to welcome you and thank you for coming out tonight. The purpose of tonight's presentation is to provide more information about the city's Housing Improvement Area Program, or HIA. So housing improvement areas were created by the state of Minnesota, to allow cities to provide homeowner associations with a source of rehabilitation financing. And last year, 2014, the Bloomington City Council authorized the Housing and Redevelopment Authority to administer its Housing Improvement Area Program in the City of Bloomington. And my name is Doug Grout, and I work for the Bloomington Housing and Redevelopment Authority, along with Brian Hartman and Brian Deerwachter. The Bloomington Housing Authority is a division of the City of Bloomington, and we're joined also tonight by Michaela Hewitt, who's the city's finance advisor from Springstead. So the PowerPoint presentation tonight is going to take around 30 minutes, maybe a little less. Most of the information we cover tonight is on our website, and we're going to put our website address on the presentation. It's on the screen a little bit later. We're going to leave plenty of time at the end of the presentation if you'd like to ask as many questions as you'd like about housing improvement areas and the process involved with setting one up. So with that, just a couple of quick notes. There are actually, we believe, over 100 association communities in the City of Bloomington. So the City Council and the Housing and Redevelopment Authority Board thought it would be worthwhile to at least set a program like this up so we can provide it to any interested HIA communities that, or association communities that may be interested in it or may have a need for it. And there are, we think, over 4,000 units in the City of Bloomington that are considered as part of an association or a common interest community. So there certainly are quite a few developments that have been built with homeowner associations over the years in the City of Bloomington. So with that, I'm going to turn it over to Brian Hartman from our staff, and he will begin the presentation.
Good evening, everybody. I am Brian Hartman, and I'm the program manager for the Housing and Redevelopment Authority here in the City of Bloomington. And I'm excited to bring to you tonight this presentation. Brian Deerwachter of our staff will also be participating in the presentation. We'll do a little tag team effort here. The first thing we'd like to do is kind of define for you what a housing improvement area is. A housing improvement area is a defined area where a townhouse or condo association exists and has applied to the city to receive financing to do a major rehab of some type at their property. An HIA would be set up for an association, a condo or townhouse association, who is unable to obtain financing from another source, whether it be a bank or other type. The association would approach the city because it cannot obtain financing to do major improvements. And Brian Deerwachter is going to go over what type of major improvements would qualify for an HIA. The ability to create an HIA is provided in state statute. If you're looking for something to do some late night, having trouble to sleep, here are you can Google the statutes here and give them a read. But this is what our program is based upon. This gives the city the authority to establishing an HIA program. One of the key features of an HIA is how the loan is repaid. It is repaid through an assessment to the individual homeowners, whether it be a condo or a townhome. And it will be collected through their property tax payments over either a 10 or 15 period of time, to 10 or 15 years. The period will be set by the type of improvements that are made for the HIA. So this is really a key feature to the program. You know, that having that assessment based right on the property allows us to collect payments in a very safe and fashion. It's not like a typical loan where you're making monthly payments. It's just rolled into your property tax amount, which usually is rolled into your mortgage payment in most cases. So it's a very safe and secure way for the city to collect that, and thus we can offer a much better interest rate. One of the key features of the program is that the bonds that will be issued for the financing will be based on the city's credit rating, not the associations. And so the city has a very good credit rating and can obtain financing for a very inexpensive amount. So in a way that you can't an interest rate that you couldn't beat in the private market. The improvements that an HIA can be used for at the townhouse or condominium association are for common elements only. So this would not be anything that's like within each individual house or unit, but the common elements that is owned and managed by the association itself. So next up, Brian Derwachter is going to talk to us about what are eligible improvements.
My name is Brian Derwachter. I'm a program specialist too with Bloomington HRA, and I've been involved with many types of rehab programs for many years, and I have not been directly involved with an HIA, so I think it sounds like a wonderful program, and I think it's worked for several other cities. So I'm on a learning curve too, but I do understand the eligible improvements, and I'd like to just run over those briefly with you. As Brian had mentioned, the improvements are for common areas only, and the association must be the responsibility of the association. So in other words, any common areas that in your governing documents state that the association is responsible for those improvements, those are eligible for the most part. And if we look, go to the next slide here, we give you some examples that may be eligible: windows, siding, roofing, parking lot resurfacing, common entry doors, HVAC, elevators. And that's not completely all-inclusive, but that's a pretty good start as far as what can be eligible. Now, we say may be eligible because of the governing document thing. If it's something that is a responsibility of the individual unit, then it's not going to be eligible. Let's see if we look at what isn't eligible. We're looking at those items that are the responsibility of the homeowners and the membership's individual units. So if you're looking at an owner of an individual unit, you can also apply for the city's housing rehabilitation loan program. It's a single-family rehab loan that you do not make payments on until you sell the property, transfer title, or no longer live in the home. That program is completely separate from an HIA. I want to make that distinction. They are totally separate. And it's also available anytime. We have funding available for unit owners. So if you can pass that on to your membership, we would appreciate that too, because there is ample funding available right now, and it is a very good program. The financing itself is, we call it deferred or delayed payment loan. So if you're income eligible and you have equity, you can use this funding to make the improvements and not pay it back till you sell the property. So what to consider for an HIA designation? I guess the carousel goes back to Brian again.
If your association is considered an HRA, we have some things that you need to think about. What the needed improvements are. And most often you'll see this completed through a reserve study. A reserve study is a required document that each association should have that should lay out the capital improvements that are going to be needed by the association for the common area elements over a period of time, typically 20 or 30 years. A reserve study will help identify those items that are either in need of a repair at present that haven't been addressed, or when they're going to be scheduled to be repaired. So maybe your elevator needs to be replaced in 15 years, or your parking lot's due to be resurfaced in 10. Those will help identify those items, and also will then back into what your reserve amount is that you presently have, and whether there's enough there to cover those needed improvements, and also based on the amount of dues that's coming into that reserve fund. So what could happen is that the reserve study will identify a shortage or a need, in that there's no other way to fund that. The association does not have the ability to pass a large assessment because of the amount of work that needs to be done, and they would like to stretch it over time. So that's where an HIA would really fit well. The reserve study will help identify what the costs of the needed improvements are. Before you go down the road of applying, some things for you to consider. Have you exhausted all other means of financing? Have you approached a financial institution like a bank to see if the association itself could borrow the money? The HIA is designed for situations where the association has no other means of financing the improvements. So we want to be the lender of last resort. 60% of the owners must approve of the HIA financing. So you'll need to take a sniff test basically of your association members, maybe an informal poll to see if there is that amount of support, or maybe there's some education that needs to be done, that sort of thing, because there'll have to be at some point what we call a petition. So you'll petition, a petition will be circulated amongst your homeowners by the board, asking for signatures to make sure they get to a 60% level of the homeowners to go forward. If you're unable to meet that 60% threshold, then the HIA would not be approved by the city, and it would not go forward. So again, the process for establishing an HIA is determine the level of homeowner support. That's that 60% level. We have an application that will be posted on our website that will explain all the details and all the information and paperwork that needs to be submitted with that. We'll need copies of your bylaws. We'll need copies of audited financial statements. So every 3 years, I believe, is the requirement that an association must have their finances audited. So we need the most recent copy of that. There is a fee for the application. It's $500. That would need to be included with the application itself. For this round of funding, for the 2015 round of funding, the applications will be due May 15th. So there's some time to get stuff together for people to think about it and talk to their members of their association to see if it's something they would like to pursue. We will require the reserve study to be submitted to the Housing Authority for review, along with our financial advisor, Springstead. We'll need evidence that you have approached banks or other financial institutions and have been turned down. So we're going to be the lender of last resort for you. We'll need a submission of the project's scope. We need to know what you are planning to do, whether it's roofs, windows, siding, all elevators, what are the elements that you need to fund through the HIA. We'll also need to receive the petition, and that's a formal legal document, and that would include all of the signatures that you need in order to hit that 60% threshold. Eventually, if your project is moving forward, you'll have to get competitive bids for the work that's going to be completed. Because this is public financing through the city, we need to make sure that it's a good price that is going to be paid for the work. So there'll be a competitive bidding process that Brian Derwachter would oversee. Submit the final scope and cost of the HRA once you get your bids. There is a formal development agreement that will be drafted between the city and association. So this is the formal legal document that will allow for the financing to happen. There will be a public hearing in front of the city council. So the city council has to approve the financing, and so a hearing will be conducted where the project and project scope will be explained, and then they would take testimony from anybody, residents or the other member of the public who would like to speak at the hearing about the HIA. Once it's approved by the council, then we would execute the agreement between the HRA and the association. The Housing Authority has been charged by the City Council with implementing this program on behalf of the city. Once that's all done, the bonds are sold, then we receive the funds, and then they can be released to the association for the rehab to begin. At this point, we're going to turn it back to Doug, and he's going to kind of wrap up for us and go over the key points of the program.
So it's a lot of information. The process takes months to go through, and we think that the result is ultimately worth it if it's something that benefits your association. So I'm going to repeat some of the things that either of the Bryans had just stated during the presentation. The petition. The petition actually comes later, so this year it would be in the summer, later in the summer. But 60% of the voting members of your association need to approve an HIA. And so one of the things that we encourage associations to do is have a meeting. Ask, the members of your association if this is something that would interest them. And some cases it might take a few years to reach a 60% threshold if it's something that if it's something that your association decides to do. There have been examples of that where it's taken a few years for associations to decide to do a housing improvement area. But get a good idea early on of what the residents think about a housing improvement area, and do a straw poll. Just count and see how many are in favor or opposed. whether that's going door to door, having a meeting and discussing it. We would certainly be at some point willing to come out to a membership meeting if that would be something that would interest you. If you don't have a reserve study, you should get one. I think, as Brian mentioned, it's something that is required under state law. I think they have to be updated every 3 years. Is that correct? So if you have a reserve study, great. If you don't, we'd strongly encourage you to go and get one. That's what we're going to look. It's an important document for us to look at, to see what the capital needs are for your development, and if you have the money to set aside, or you have the planned money set aside to fund whatever improvements you have coming up. So there's a public hearing that takes place that Brian had just mentioned. This whole process, if it starts and if the petition is successful, ultimately would go to the Bloomington City Council for final approval. As Brian said, the financing that we talk about is through bonds, and the City of Bloomington has the best bond rating you can have as a public entity. I think there's only a few dozen governments around the United States that have a bond rating this good. So we have to get approval from the City Council ultimately to do a housing improvement area. And that would be usually typically in the fall before the city issues its annual bond funds. And this is this veto period is an interesting aspect of the program. So after the City Council approves, assuming they approve the housing improvement area for your association at the City Council meeting, a veto period begins. That lasts 45 days. That provides the residents of your development with the opportunity to essentially veto or stop the HIA from occurring. And I believe the threshold number is 45%, correct, Michaela? 45% of the residents, or the voting members, I should say, of your association, have that 45 days after the City Council approves it to basically do a reverse referendum of sorts, to come in and state that they do not want this to happen. And that's what it'll take at that point to stop the HIA from happening. Once that 45 days is done, the bonds are issued and we can begin the rehab process for your development. And the fee structure is, for whatever association that you reside at, is important because fee structures are handled different ways at different associations. The bonds that are issued to do the rehab for your association are going to be paid back through an assessment process, just like property taxes. It'll be paid alongside of your property taxes, and a fee will be assigned to the homeowners depending on what the governing documents of your association state. It could be every household pays an even amount, or it could be the square footage determines what your percentage of the improvement debt service repayment is going to be. It just all depends on how your association is set up. But it is a process, and these are some key points that we thought, especially the 60%. If 10% of the residents in your association want to do this and 50% don't, and the other 40% don't care, it could be an uphill battle to get. So spend some time finding out whether it's something that the residents of your association are interested in. But it is a unique financing source. I was talking to someone from a management company a little bit earlier. City of Oakdale does this, the City of St. Louis Park, several other communities, probably a dozen or so communities just around the metro that do housing improvement areas for associations. So it's a tool that we want to have here in the case that an association does have serious capital needs that they just can't afford to pay for in any other way. So that was behind the thinking of both the Housing and Redevelopment Authority and the City Council when this program was created. Another key point is how much will each unit be responsible to pay, and for how long? How much are you borrowing? And what's the individual debt service for each unit going to be in the repayment of that? I mean, you don't want to borrow more than you need, but can your residents, do you feel, afford to pay the debt service back on a per unit basis or per square footage basis, however they're assessed? Important thing to consider. And that's information that once we know the scope of the project and roughly what it'll cost, we can provide some data on that. Our minimum project size, $250,000. Because it is such a process, and most of this is in statute. I mean, some of it we've created internally, but most of what we have to go through is required by state statute. We want to make sure that it's a good investment of everyone's time, and $250,000 seemed to be the minimum threshold that we wanted to cover. So your project has to be at least that big. There's no maximum, I should say, but I think every association will have their own governor to determine how much they feel that they can afford to pay back, and it's based on what you legitimately need to do as far as the renovation. It's a competitive application process in that to meet the city's bonding timeline, which they issue bonds every fall, we have a lot of stuff to do in a short amount of time to do it. So this year we're going to stop accepting applications at May 15th. And we're going to take a look at the applications that come in and review them. And the application that we feel is most realistic in terms of being able to be accomplished within the year. Things like that 60% threshold will be important, but we're going to do the project that meets the goals of the policy, the HIA policy that we have established in the city, that the HRA board and city council have approved, and that we feel just has the best chance of happening. So we're gonna look at a lot of different factors when we're weighting these applications when we receive them, or we might not receive any. I think it's gonna vary year to year. This is the first year that we've done this, so we don't really have any historical perspective. The due date, as I had mentioned previously, is May 15th of this year. And we say applications. The application's pretty simple. I think it's 2 pages, and there's some supplementary information that we require that be submitted. But it's not a lot of information, and you could certainly go ahead and submit an application and then find out during the summer, later in the summer, when we go through the petition process, that you don't have 60% of your membership willing to do this. You can't get 60% of the voting members to vote in favor. That's okay. I mean, the application fee is relatively small. I think it's $500, which goes in with the application. But we would encourage you then to, if you feel it's still a worthwhile initiative that you'd like to do for your community, you can come back and apply again next year and just keep working to get to that 60%. So you certainly can apply and decide not to do it later in the process. The website for the City of Bloomington is, you can see it up here on the screen. It's bloomingtonmn.gov. And if you go to that website, we're a division of the city, just type in Housing Authority. You could type in HRA, that's our acronym, and you'll find our website, the Housing and Redevelopment Authority website. We've got an area of our website that we're going to use to kind of pool all of our HIA information, housing improvement area. You could also just go to the city's website and type in HIA, and that'll take you right to this specific section for housing improvement areas. It's almost set up. The website is there. We don't have all of the documents onto it yet, but we expect to by next week. So feel free to go and take an early look at it. By next week, the application and everything else will be on there. We also brought some applications tonight in case anybody wants to just look it over if you're interested. But, just speaking from our opinions, what we would counsel is that all associations that are considering this, take a good, long, hard, kind of introspective look at what needs to be done and your ability to pay for that. If you have some serious and defined, capital improvement needs, and you just don't have the funds to pay for it, this might be a good option. If there are other ways that you have to finance these improvements, maybe that's the best way to go. But it is certainly a commitment. It's a commitment of time, and it's also a commitment of repayment. I mean, we're talking hundreds of thousands, potentially in the low millions of dollars that might be needed. So we feel we can do 1 or 2 in the course of a year. We have the staffing to do that and the wherewithal as far as just the money to finance those through the bonding cycle. In the future, maybe more. But back to the point on research, please, read the state statute. It's out there. Read our HIA policy, which is on our website, which explains how we operate the program. You can do an internet search and just look at other communities that have done this program. There's some newspaper articles actually that have been written about communities that have gone through the housing improvement area process to make needed improvements. There's a lot of information out there, and if you're willing and committed to go through the process, it's probably, while it's the last resort of financing, it's probably the best financing you can get for doing these things because the interest rate is so low, because the City of Bloomington has such a strong financial rating from the bond companies. So at this point of the meeting, we've talked enough. We're here to answer any questions that you might have for us regarding the Housing Improvement Area program. It's set up now. We're going to start doing HIA loans probably this year if there's interest. So we have sent applications out to every association in the city and to the relevant management companies for those associations if they're not self-managed. And so As with all programs, sometimes you have a small start, but we'll see how it goes. So right now we are planning to use the city's, bond capacity to finance this. They issue bonds, and we use those funds to make the HIA a loan. In the future, we may decide that we're going to self-finance, meaning we'll identify a source of funds through the Housing and Redevelopment Authority, and we'll be the direct lender that way. That's not in place now, but it could be, certainly for 2016 or beyond. It allows us a little more flexibility as far as timetable goes. Cities do it both ways. Some housing authorities or the administrators of the Housing Improvement Area Program always go through the city's bonding process. And again, there are advantages with the City of Bloomington in that their financial bond rating is so high that it's the cheapest source of funds that you can get, and it's very stable. But other cities like the flexibility of being able to make an HIA loan at any time. And so they've identified another source of funds that they use as a revolving loan fund of sorts. So that's one point. And the other point I was going to mention that we didn't really touch on tonight was that as we review the financial situation of every association that applies, we're going to take a look at the reserve study, and we're going to look at the association fees. And if the problems of deferred maintenance or capital improvements have been created by the fact that there's just not enough money coming in to the escrows, we'll probably identify that, and we'll ask the association to raise them. Now, we don't want to run anybody or cause anybody to lose the affordability of their home, but if they've been too low for too long, certainly at least need a plan to begin raising them to whatever level they need to be, so you have a source of financing in the future that you can use to cover your capital needs. Reserve studies will likely identify that, but that is another thing as we look at the financial statements for the individual associations that we'll certainly look at.
Yes.
If I just wanted
Yes.
to add just to that, I think as you heard, the purpose of the HIA financing, it is the last resort, and essentially what we see are associations that have, for whatever reason, their capital maintenance costs have been deferred. Their association fees are too low, and as a result, they're in a pickle where they can't get financing. They're not able to finance these improvements in a cost-effective manner. The point of the reserve study and all the analysis that goes into it is that at the end of the day, you've got your improvements that have been deferred, financed, and hopefully a cost-effective means for the homeowners, and you have a financing plan moving forward that in 20 years from now, you're not coming back in the same position. So it is trying to balance and understanding that's kind of a painful period because you're trying to go backwards and finance improvements that weren't done, plus you need to plan for the future improvements so you're not stuck again. So it's trying to manage all of that, and that's what the reserve study and the audits and all of that analysis does, is to try to blend those two together so that you've got a financially sound association moving forward after this financing. But that's all I wanted to add.
Thank you. Thank you, everyone.